Welcome to this session, the compliance panel. And just a bit of a background. This is UUBO's ICE series for 2022. The ICE series, ICE simply means Investigation, Compliance, and Ethics, is UUBO's flagship program summit that discusses trends in the investigation, compliance, and ethics space. And we do this annually. And this year, we've crafted very interesting conversations along the lines of these three broad areas. Yesterday was a super interesting session. The investigations panel discussed charting a path for effective remedial actions. And we had panelists from, from the firm, from UUBO, from Mayor Brown, and from Covington, and other organizations. Today, we'll be discussing the relevance of tax compliance in managing tax disputes. So this is the compliance panel. And tomorrow, we would have the ethics panel, where we'll be discussing corporate governance mechanisms and ESG reporting. So, I mean, I'm really pumped up for this about this conversation, because these are very important issues and areas, for tax point companies and individuals, both in Nigeria and internationally. So I'm so excited that we'll be having this conversation at this time. So just to set the ground rules, we'll be starting, the panel session will start right now. But just to set the ground rules, if you have any questions, you put in your questions through the Q&A box. And then there's a chat box for just, reactions, comments, and the like. So please, if you want your question to be answered, send them through the Q&A box, and we would have someone pick up the questions and respond to the questions. So please do not put your question in the chat box, in the Q&A box. Thank you very much. And this afternoon rather, we have a very wonderful panel, carefully selected panel of experts who will be discussing the relevance of tax compliance in managing tax disputes. And just a bit of a background around the importance of this topic. Increasingly, tax authorities are becoming, very conscious about driving compliance among taxpayers, particularly in Nigeria. And you would find that the tax authorities have built more capacity. They have more training now, more resources, more facilities, and to drive compliance across various levels. And this means that taxpayers need to be more compliant. They need to tighten their tax function to ensure that they do not run foul of the tax laws. And most times, lack of compliance will lead to tax disputes. So we decided that it would be important to have a discussion around the importance of tax compliance in managing tax disputes, between taxpayers and the tax authorities. And so the panel this morning is carefully selected to discuss this issue from different standpoints. We have an official from the tax authority, from the Federal Inland Revenue Service, the FIRS. We also have a tax practitioner. We also have a tax judge, and then a partner in in a Big Four law firm, with international experience, to also share thoughts on international perspective to this conversation. And so within a short time, I will just, ask the question, but just before we do that, I'd like to give us a bit of a background to the speakers. So on the call today, we have Barrister Chukwuemeka Eze. Barrister Chukwuemeka Eze is the chairman of the Tax Appeal Tribunal in the Southeast Zone. He's a lawyer and legal advisor to, he's a lead legal advisor to the CIT, and that's the Chartered Institute of Taxation of Nigeria. He's a member of the International Association of Tax Judges, and he is an eminent tax practitioner himself. He used to be a tax practitioner himself before he, joined the bench as a tax judge. He's also a PhD student of international tax law. Also on the call as a panelist today is Mrs. Lola Ososami, who is a partner with UUBO's Taxation, Corporate Advisory, Compliance and Investigations, and Oil and Gas team. She advises clients regularly on tax structuring and compliance, and advises clients across various industries. She's been recognized in various legal directories as a leader in tax matters, and we're pleased to have her. She's also a fellow of the CITN herself and has also at different times lectured at the CITN. We also have Sarah Blakelock, who is a partner at Deloitte in London. She particularly works in the tax controversy team of Deloitte and has extensive experience at assisting clients in international arbitration and general compliance. She has appeared in tax disputes at the tax tribunals in higher courts in the UK, and has assisted clients resolve myriads of tax issues. And finally, we also have Mr. Kayode Ayodele, a manager with the FIRS, who is himself also a fellow of the Institute of Chartered Accountants of Nigeria. And he has a BSc in accounting and an MSc in view in accounting. So we are pleased to have this eminent panel today, and we'll start right away. And to kick off the conversation for us today is Mr. Ayodele, the manager with the FIRS. So, Mr. Ayodele, just to set the background for us in this conversation today, how can companies manage their tax function to avoid tax disputes with tax authorities? We'd be grateful if you can share some of your thoughts, your experiences from the work that you've done so far, as an official tax authority. Thank you.
Thank you, Mr. Kelechi, for having me. Good afternoon, everyone. I hope you are all hearing me. This topic is a very important topic, and it's a very topical issue, considering the level of taxation in Nigeria, how important tax revenue is to Nigerian economy. So essentially, permit me to start by saying that, organizations all over the world are set up primarily to maximize the shareholders' wealth. And in doing this, they try as much as possible to enhance their level of profitability and growth. And in doing that, also has a kind of conflict of interest with taxation, in the sense that tax, as it were, is a function of profits made by the company. So there is a conflict there, because companies are trying to increase their profitability, and at the same time, there is a stake of government. Government also has a stake in that profit. So it is a conflict. But how does the company, how do they manage these conflicts such that they do not run foul of a tax law? That is what brings about this conversation that we're having. And one of the things that I believe company can do, from my experience, in order to manage their tax function, is basically to engage or to have competent tax personnel. Is very key. Competent tax personnel, because the taxation world is very dynamic now. You agree with me? In the past 2 years or 3 years, we have about 3 amendments in terms of finance acts to our tax law. So if you are a staff that handle tax functions and you are not competent in this regard, it creates a big gaps, and that could lead to higher exposure in terms of taxes to the company. So it is important for companies to have a competent personnel in this regard. And another area that a company can also use to manage their tax exposures is to also separate tax functions from finance function, because experience have shown that companies usually match these two roles together. And because of the complexity and the volume of transactions that we have nowadays, there is need for companies to separate these two functions so that there will be concentration on tax functions. Because if you marry finance function with tax functions, you overburden the personnel, and that could create a gap, that could create errors. So in order to manage this, it is important now that companies try as much as possible to separate these two functions so that those in tax function can concentrate and they can use that time to be abreast of what is happening in taxation world. It is very key. And another area that I also talked about in terms of managing tax function is, documentations. Documentation is very key, because there is a saying in audit that what is not documented is not done. It is one thing you carry out a transaction, it is another thing you have documentary evidence that will show, that will prove that of truth, you actually carry out this transaction, because that is what auditor is looking out for. So there must be proper documentation, there must be proper archiving, there must be proper posting. So these are the things that company can use to manage their, because when there are issues, the cost of prosecuting, the cost of compliance could be overwhelming. But when there are basic documentations, when things are being done the way it should be done, company can save themselves from all these issues. So these are the things that company can adopt to actually manage their tax function. Thank you.
Thank you so much, Mr. Yadele. I mean, it's very succinct the way you've put it. And I think the conversation around documentation is very interesting, and I'd like to interrogate that a little further. Could you please share with the audience, some strategies that companies could adopt to manage documentation, filings, tax payments, the likes, to make tax audit exercises a lot easier? Because from experience, you also know that most times when the tax authorities come for audit, they'll ask you bring some documents, and the company takes so long to find the documents, and they are not able to provide those documents within the time frames stipulated. So from your experience, can you share some strategies on how companies could manage their documentation so it's easier to retrieve documents and share, and also how to manage tax filings and payments efficiently?
Well, that's very interesting. I think in tax audits, what auditor look out for basically is to ascertain and verify the numbers that company has in their financials. Because of the self-assessment regime that we have, company is permitted, is allowed by the law to self-assess themselves and they pay the required taxes based on the assessment, the record that they file. So in that background, it is behoves of the company to prepare all the necessary schedules, all the necessary, evidence of payments, payment vouchers, invoices, supplier invoices, all these things have to be well arranged. Whatever numbers, whatever figure company has in the audited account filed to the relevant, to the tax authority, company should know that what the auditor wants to do is to just verify them. And how do you go about this thing? Is to, arrange yourself such that those documents are accessible. Not only that they are accessible, they must be understandable. That is, auditor must be able to relate with such document. For eventually, there's an invoice that is not written in English language. It is the onus is on the taxpayer to ensure that invoices or that documents were translated in the language that the auditor will understand. And again, if there are any unusual transactions, it is important for company to ensure that these unusual transactions are well documented, are well supported with all the documentary evidences. For instance, let me give you an instance. When it comes to tax audits, one of the issues that usually arise is audit journal, for instance. Of course, company can, you can make audit journal, you can adjust your records and all that. But when you are doing that, you should have it at the back of your mind that auditor will request for underlying document. Because before you can raise a journal, for instance, there must be something that happened. Maybe there's something that you mixed out, or maybe there's something that you did not post accurately, or there was an overposted of a figure, underposted of a figure. You must be able to support that journal with underlying documents. What do you see? Why? What led to this adjustment journal? So these are the things. You must know that whatever audit adjustment journal you pass into your records, you must have an underlying document to justify that. Because if you don't support it with underlying documents, it becomes an issue. It becomes an audit issue. And when auditor could not verify, of course, it could lead to tax exposures. So these are the things that company can do. These are the things from experience that more often than not, when you request for documents, most documents are not provided timely. And when they were provided, they were not explanatory. The auditor more often than not find it difficult to relate with such document. It's not about providing document. It's about providing essential and relevant document that can speak to that transaction that you've posted. And in that regard, auditor can now place reliance on such. And another thing that I also observe over the year is that companies hardly seek for further clarifications when they are confronted with unusual transactions, because we usually have transactions that are not in day-to-day, transaction of the company. Maybe it's one-off transactions and all that, and they are not sure of the tax implications or the issues around those, transactions. What they can do is to seek for clarification. And I think Federal Inland Revenue has a department that you can easily, write to request for further guidance in case you don't understand the tax implication of such transactions. I mean, tax policy and the advisory department comes handy in this.
Yeah, it's interesting, Mr. Ayodele, that you mentioned the point around seeking clarification, and it's a very important part of this conversation today, and we'll get to that very soon. But I think the key takeaway for me is that the companies should always seek clarification when they're unsure of what to do, and every transaction should be properly documented, and justification should be provided in the event of an audit. So that's a very important point you've made. And I think that takes us to the next question, because you see, documentation relates more to evidence. And from my experience, oftentimes tax audits lead to disputes. So the FRS or the tax authority generally would raise an additional assessment after the audit process. The company would usually dispute that, and most times they'll end up at the tax appeals tribunal. And it's a great thing that we have an eminent judge of the tax appeal tribunal in the person of Mr. Chukwuemeka Eze. So, Mr. Chairman, this question is addressed to you. In your experience, sir, could you please share with the audience whether cases you've at least experienced, you've sat on, have been won, or lost on the basis of evidence, on the preponderance of evidence, or mostly on technicalities? Because we're trying to interrogate the importance of having proper documentation when you go to the tax appeals tribunal or to the higher courts. The value of having proper documentation and enough evidence to support your case in the event of a dispute.
Thank you very much, Kelechi. It should be said straight away that preponderance of evidence will help a party in the tribunal. Although we are not strict in application of the provisions of the Evidence Act, Nevertheless, we substantially comply with the Evidence Act. I want to give instances. For instance, service. If a party comes to the tribunal to argue that it was not properly served, the purposive interpretation of tax status will not permit us to go into such technicality. So whether you are served in person, you are served through third party, whichever way, they go by way of that you have been served. So there is no provision of Evidence Act or any other act to try to act or make. So I just gave that as an instance. So, but preponderance of relevant evidence will be more important than just preponderance of evidence, because let me give a practical instance also. There are situations lawyers bring in their clients or witnesses to give evidence of how they served certain documents, how certain things transpired. At the end of the day, the lawyer may want to establish that certain things were done the way they think it should be done. But let me say, assuming it is the issue of filing of returns timeously or within the period allowed by the law, whatever evidence you bring, and it has nothing to do with whether there was compliance within the period allowed by the law, such preponderance to us will go to no issue. Because of what purpose will it be? Or you provide preponderance of evidence that will lead to evasion for us to be used as a tool for tax evasion. Such preponderance of evidence will not be useful to us. So we look at the purpose. Will all this evidence you've given amount to using us as a tool to evade tax? If the answer is yes, then your preponderance of evidence will not be very useful. But if the preponderance of evidence will lead to establishing that you did what you were supposed to do, or you didn't do it, but the penalty or punishment being given to it does not apply, then that will be very useful. Then we can look at instances of you've been asked to pay tax within a period, you pay the tax within that period, even if there is no much evidence, but you have evidence to show, undisputed evidence to show that you paid tax within that period. And you bring out the document to show this is the receipt with which you paid, the date is on it, it falls within the period. I mean, it is sufficient. It is not the tons of evidence you bring that matters, but the quality of evidence you have brought. So that will be good enough for that purpose. I need to also add, in a situation where you've been accused of under-remittance, and you bring up evidence that show, like some people bring up schedules of remittances without the actual documents showing evidence of remittances. For instance, bringing up a schedule, maybe a particular year is applicable, let's say 2020, you bring up a schedule showing you paid from January to, assuming it's personal income tax, you did the deductions, then you remitted month by month or month by month basis, and it is shown on a schedule. Then the next issue will be, where are the receipts you obtained from maybe let's start with the instructions. You instructed your bank to make those transfers. Show us the evidence of those instructions. Yes. Do you have evidence of actual receipt by the tax authority? If there is evidence of actual transfers in bank statements showing that they were transfers to the tax authority, and maybe the tax authority did not issue you receipts for the 12 months you have shown in your schedule, but we have actual evidence of transfer to the tax authority. The fact that you didn't produce the receipts for the 12 months will not go to any issue, because sometimes tax authorities may have reasons not to issue those receipts, and they come to canvass, oh, you produced only 10 receipts. You did not, for 10 months. You did not produce for the other 2 months. That will not be good enough before us if there is evidence to show that there were transfers for 12 months for the workers of the company. So do you get it?
Yes.
All right.
Thank you so much, Mr. Chairman. And that point you made is so important, that the tribunal could rely on circumstantial evidence I mean, in the absence of actual receipt of remittance, you could rely on other supporting documents that point to the fact that the taxpayer has complied with tax remittances, and which is really, really, comforting to know. And I mean, the next question is, I mean, I'll be addressing
Kelechi, before you go to the next one, I need to correct something.
Okay, sir.
When it is a company making remittances, we don't address the company as the taxpayer. The company is not the taxpayer, yes. Okay. So, because the company is the agent of the tax authorities.
Correct, yes.
And has deducted and made remittances on behalf of the taxpayers in its employ.
Okay, thank you. So that's in relation to payee specifically.
Yes, in relation to payee.
Okay, all right. Thank you, sir. Thanks for that. So I'll be speaking to Mrs. Blakelock. Sarah, could you please share your experience on the importance of evidence in tax disputes from your international experience?
Yes, thank you, Kaleki, and thank you for inviting me to come and join this seminar today. I'm going to provide a bit more of a broader international perspective about evidence and some of the, struggles that both taxpayers and fiscal authorities find in terms of dealing with evidence and dealing with facts in tax matters. And one of the difficulties, I think, is that there's often a reluctance on the part of taxpayers to gather and collate facts and evidence early when there's a review or an audit of certain positions. And that's a common issue right around the world. And the reason why there is a reluctance to do that is that taxpayers are concerned about how consuming that exercise is. And I've heard what Mr. Ayodele has said this afternoon about taxpayers being ready to be in a position to respond. But I think there's a concern from a taxpayer's perspective that they're wanting to get a better understanding of what the issues are that the tax authority in any particular jurisdiction is interested in, and understand that concern and issue and how it arises in advance of them going and having a look for what is the evidence that supports their underlying position. But of course, at some point, that's something that taxpayers are going to need to do. But on the other hand, from a fiscal authority's perspective, there's a question about how to engage well with taxpayers from a cooperative compliance perspective in order to give some guidance about what some of their concerns are and what some of the issues are. And so taxpayers can be ready to respond to that issue and start to think about where their tax risk is and what their tax risk governance response is. And we've heard this afternoon some part of this in terms of what that should look like at the term of filing, at the time of being in a self-assessment system and filing your tax return and making a position and taking a tax position, and the need for work papers to be in place and for primary source documents, which of course need to be gathered and stored in an appropriate way to be able to support the position that's put. But often when matters go as far as tribunals all around the world, whether they're tribunals or courts, and they will be different in different jurisdictions, there often needs to be more evidence than the primary source documents and papers. And sometimes there needs to be secondary documents and also witness evidence as to what was done and how it was done and what was done in the particular period that's under question. One of the difficulties that taxpayers often have is issues regarding proof, because some of that additional secondary material that supports the primary source documents and the witness evidence is not always readily available at a later point in time. And sometimes taxpayers tend to resort to making tax technical arguments and putting tax technical positions before revenue authorities in advance of really establishing what those facts are. And that's very much about the fact that it takes time to put that secondary and witness evidence together in order to explain what the position was that was originally taken. But of course, for taxpayers, this is a difficulty because you can't run alternative fact scenarios because there is only ever one set of facts and the factual findings will need to be made. But you can run alternative tax technical arguments concerning what those facts are, how they should apply to the law at any one time. And so it's something that's important for taxpayers to keep in mind. So navigating this hurdle is important, both from a fiscal authority's perspective about how do you get more taxpayers working in compliance with the law, and that's about providing greater opportunities for guidance and direction and nudging taxpayers and using some of those different principles we've seen arise in cooperative compliance globally. And one of them, which Mr. Ayodele explained this afternoon, was around engagement in seeking some guidance on positions. And that's an incredibly important aspect that fiscal authorities can play here. And so evidence is important, but that guidance and other side of the coin perspective from a fiscal authority is just as important.
Thank you. Thank you so much. Very interesting points you made around, whether to plead alternative facts or not. And it does appear that for tax matters, factual evidence always is preferred to pleading alternative facts. And it's a very great point you've made. And I'm sure that the taxpayers on the call are taking notes and will be more deliberate when, documenting transactions to make their case a lot easier. But you talked about engagement, and I'm sure we'll get to that. But at this point, I want to address the question to Mrs. Ososami, who is a tax practitioner, and advises clients on how to manage their tax exposure. So, Mrs. Ososami, could you? We've been hearing very recently that tax compliance is a new phase of tax planning. We'd like you to explain what this means for taxpayers that seek to minimize their tax exposure, and what it also means for tax practitioners who advise them.
Thank you, Kelechi. Yes, so I think the best place to start is to first of all diffuse thoughts about what tax planning really is. Tax planning, you find, means different things to different people. So typically when you talk about tax planning, everyone's mind goes to how to minimize tax exposure, but that's just one aspect of tax planning. That's not all that tax planning is about. Tax planning really is about risk management, managing your potential exposure to double taxation or multiple taxation. Also, tax planning is about finding more efficient ways of tax compliance by blocking leakages And this is especially relevant to multinational enterprises as well as group structures. For single entities, it's fairly simple. But when you start to have group structures, whether domestic groups or multinational groups, then it begins to get complex, because you then have entities. If it's a domestic group, you can have entities that are operating, within different, from different states within the country, ensuring that something as simple as remitting payee, making payee remittances, ensuring that there's no overlap, where someone in Ogun State is remitting taxes to the Ogun State Internal Revenue Service, because that individual in the records of the company it resides in Ogun State, but incidentally, he works more from the Lagos office, and then remittances are also being made to the LIRS. So tax planning is very important. Now, coming back to your question as to tax compliance being the new face of tax planning, what that simply means is that for organizations that have had an approach to tax planning that is primarily focused on creating or developing structures that are designed with the primary motive of avoiding taxes, they then now need to be more careful, because there's a global reform now that can be described as somewhat aggressive towards tax avoidance. So certain standards of tax avoidance that were acceptable previously are now being frowned upon. And so this is where the transition from moving away from avoidance more towards compliance becomes necessary. And so now in tax planning, an approach to tax planning must now be one that is a proactive approach by the taxpayer. In other words, just like Mr. Adele mentioned, that the FRS, for instance, has a desk where you can come and seek clarification on structures that you're trying to put together as an organization. Before you go to the FRS as a taxpayer, it now makes sense to also run structures by your advisors for them to test that structure and to see that this structure does not come across as a potential tax avoidance scheme, but rather there's substantial evidence to justify this structure as being the most efficient structure for the organization. So that proactiveness is very important. Another thing that is also important is that in taking tax positions now, organizations must be very careful as well, because there's a lot more transparency now. So in taking a tax position, you must test that position against these various standards. You must test it against the standards of transparency. You must test it against the standards of substance over form. You must test it also against the overlap between the domestic tax laws of the jurisdictions where you operate as a group. So the approach now, when we say tax compliance is a new tax planning, organizations must focus more on preventing situations where they're now having to be defensive when an audit is conducted, as opposed to being ready to justify and to support the position that they have taken. So I hope this has answered the question, both for the taxpayer and the advisor.
Indeed, it has, Mr. Susami. I mean, I appreciate some of the points you've made around the need to test tax planning strategies along the lines of transparency, just so that the taxpayer is not left in a defensive position during tax audit exercises. And I mean, the next question that I'd ask would be addressed to Mr. Chukwemeka, the tax judge. So in your view, how does compliance with tax laws, for companies impact the outcome of tax disputes? Do you see a correlation between tax compliance and success at the Tax Appeal Tribunal do you think that a more compliant company has a higher chance of, making its case or proving its case at the tax appeals tribunal? Or do you think that it doesn't really matter? I mean, I'm grateful for your thoughts on this point. You're muted, please. Yeah.
I'm sorry. I didn't know I was muted. So it matters, but I need to tell you something that does not look simplistic. Many people think tax compliance is a straightforward terminology. What tax compliance means to a tax administrator may differ from what it means to a taxpayer. I'll give you an example. You are a tax agent to a tax authority. You are a company. You are not a taxpayer to a state internal revenue service. But the state internal revenue service gives you a tax assessment or demand notice because of your employees. Your refusal to pay to a tax administrator amounts to tax non-compliance. It may be that the tax authority has decided to place a best of judgment assessment procedure on the company. To the tax authority, you have not complied in payment. But to the taxpayer, I'm not subject to best of judgment assessment procedure. So when we talk of tax compliance, it means different things to different people. What you read in a tax law that may seem so simplistic, you may discover that in terms of you may pay all, and the tax authority may come to a conclusion that you have not really complied. So, but considering the correlation, we have seen a situation where business premises, the tax authority outsourced it to a private company. The private company sent a demand notice from another company to pay 5 billion naira. The company objected to it. At the end of the day, when they came to the tax tribunal, the company that the demand was made from, the tax authority started demanding for 10,000 naira from the same company it had earlier demanded 5 billion naira from. Another company was required or requested to pay 5 billion. But when the matter came to the tax appeal tribunal, the tax authority demanded for 10,000 naira. So at the time it was demanding through a private company for 5 billion, and the other company refused to pay the 5 billion. It accused it of tax non-compliance. At the tribunal, it started demanding for 10,000 naira. So you can see what will amount to tax non-compliance can vary with time, place, and environment. And that's why I started by telling you that what compliance means. Ordinarily, in our own view, generally, we may think it's just non-payment of tax. But you may pay, and the other party will say you have not really paid what you should pay. So in terms of its impact on businesses, we have seen situations where a bank was subjected to certain rigors to pay more than what it was supposed to pay. At the end of the day, the bank decided to leave the location. left that particular city entirely, removed its branch, and decided not to operate any longer within that locality because of the way it was being troubled. Because of the nature of what we do, I don't want to name the bank, but I'm talking about live case, a case that actually came before us. So the way tax authorities look at non-compliance, over time we have seen that it is not really the way taxpayers, and it has much impact depending on who is looking at it. Sometimes when you place a best of judgment on a taxpayer, perhaps in the name of, sometimes you call it additional assessment, sometimes you bring best of judgment, and parties will begin to argue over it. Let me give another live case. A tax consultant was appointed by State Internal Revenue Service to audit a particular company concerning remittances. The tax consultant went to the company. After 2 days, the tax consultant left Lagos, went to Enugu. After 2 days, returned to Lagos. All the documents presented to it, whether it looked at it or not, but did not do detailed analysis of these documents. Just went back and prepared a document in favor of the tax authority and sent to the tax authority that it was not satisfied with the documents presented to it and requested for 10 million naira. So to the tax authority, there was non-compliance and it demanded for 10 million naira. But by the time all those documents were scrutinized, it was apparent that the employer was not having a tax liability of 10 million naira. So, and sometimes some of these companies who want to operate when they don't want to be dragged on for 1 year to perhaps 6 months, 1 year in a tax appeal tribunal. They want to negotiate in certain terms outside the law. When these negotiations continue, some of them get frustrated. So tax compliance, when properly managed, will not have deleterious effects on taxpayers and tax agents. But when improperly managed, and we have phony situations, phantom situations, and cover it up under tax non-compliance, certainly it will impact negatively on businesses. And that is where we will certainly have problems. That's where we have challenges. Yes, that's where we have challenges.
Thank you very much, Mr. Chairman. I mean, I love the direction of this conversation. I'm enjoying it, and I hope those on the call are listening in and also enjoying the flow of the conversation. And I can already see a lot of questions in the Q&A box. And just to say that we'll be taking these questions towards the end of the session. So please bear with us. And for the panelists, if you're able to respond to some of the questions through chats, please go ahead. We're happy for you to do that as well. But there's one question in the chat box, Mr. Chairman. I think it's addressed to you, and I think it's important you lay this foundation before I ask the other question. The question basically is there a tax policy or ideology that the tribunal has taken judicial notice of, in entertaining the grievances of entities that appeal disparity in taxes imposed by tax authorities? So the tribunal have like an approach or a policy or an ideology towards resolving tax disputes?
I won't call it an ideology, but I can cite one. We've made taxpayers and tax authorities to realize that we won't accept situations where tax agents are subjected to best of judgment, because it promotes laziness. You go to a company to to best of judgment with respect to personal income tax, not with respect to companies' income tax. With respect to companies' income tax, we don't have a problem with that. Once there is basis for that. But with respect to personal income tax, we've come to look at sections 54 of the personal income tax, especially subsections 3 and 5. We've looked at sections 81, sections and 82. We've also looked at payee regulations, which is a subsidiary legislation attached to the Personal Income Tax Act. And we have come to a conclusion in many cases we've decided that there is nowhere where it is provided that you should place best of judgment on tax agents. Because the tax agent, if you look at the law of agency, you see that if an agent mismanages your money, you know what to do. If it amounts to crime, you report to security agencies and you still recover your money. But it is not a situation that if an agent is holding, let's say 100,000 naira, you wake up and say, okay, I apply best of judgment, the agent will now pay 50 million naira. It's not allowed. And we have also established that in situations where a company that is a tax agent is so burdened with managing issues of handling tax liabilities of its staff, you can as well refer those, tell the tax authorities to deal directly with your staff. On the authority of Ukpom and Commissioner for Economic Planning of Akwa Ibom State, where the Commissioner for Economic Planning sent letters to Mobile in Eket, requesting that his staff should pay certain taxes based on BOJ. The company said, we've been dealing with you over time. We've been deducting and remitting. These amounts stated, they are not the actual salaries we pay to the staff. The commissioner persisted. Then the company referred them to deal directly with its staff, its employees. So that's why the case is not between Mobile and Commissioner for. It was Ukpom. They came first to the Akwa Ibom State High Court and they requested that they wanted to sue. They sought leave of court to sue in a representative capacity. That was granted. And they proceeded to sue the Commissioner for Economic Planning. So because we have seen situations where certain companies continue to insist that even in extreme situations, they must continue to handle issues arising from their staff. So if the push comes to the shove, and you are sure that the amounts being demanded are far above what you really pay your staff, I mean, why not allow them to have access directly to your staff if there is no hanky-panky? Because in some situations, some of the payments made to employees are not undisclosed by some of these companies. If you are sure, in the case of Mobile, they were sure. They were not hiding anything. So they allowed direct access. And the staff, Opa and I think about 292 others, they said, no, we can't pay based on these quotations you have given us. These are our employment letters. These are what we are paid, and we cannot pay more than this. So the matter ended up being at the Supreme Court. But one more point. There is this, I want to point out.
Okay,
we have this attitude, a situation where tax authorities will come to a particular place to audit, whether with respect to companies' income tax, personal income tax, value-added tax, or any other tax type. And they will not do a thorough job. They will just walk away and say certain documents were not given to them. We have relied on the case of Guaranteed Trust Bank and Ekiti State Board of Internal Revenue to say, where you are not giving documents, you should apply to the Tax Appeal Tribunal or apply to the High Court for order of the Tribunal or Court for those documents to be given to you. Don't go and cook up figures just because documents were not given to you. I know this is strange to some people in the audit department of tax authorities, but we took our time to explain the decision in that case and also to make them appreciate the philosophy behind situations where you have to apply. So don't quickly rush, because we have seen many cases where the only issue is that they did not give us documents. They did not give us sufficient documents. If they didn't give you documents, the ones they gave you, what did you make out of it? We want to see in the tribunal what you have made out of the ones you were given, so that let it be the ones we were given, we were able to come to this figure. If we were given
Thank you, Mr. Chairman.
documents, we would have done this. All right, thank you.
Thank you, Mr. Chairman. Your points are very well made, and I think you've made very important points, which is that the tax authorities, the tribunal will usually take an approach that the tax authorities should make efforts to demand documents before they raise best of judgment assessments, especially when it relates to personal income tax, of employees of a company. Thank you very much, and those points are very well made. And I mean, to continue the conversation, and I'd like to address a question to Mrs. Belo-Osagie around arbitration, the arbitrability of tax matters in Nigeria. Mr. Sosami, could you please share with us whether you think tax disputes should be settled by arbitration in Nigeria? And if so, how would that work? And would that enhance or impede compliance?
Okay, thanks, Kelechi. The issue of tax disputes resolution and arbitration in Nigeria can be considered to be somewhat controversial. And that controversy arose from the decision of the Court of Appeal in 2016 in the case of Esso Petroleum and SNEPCO and NNPC. It was a landmark case that involved the interpretation of the dispute resolution clause in the production sharing contract between NNPC and those parties. Now, the conclusion of the Court of Appeal in that decision was that tax matters are not arbitrable in Nigeria. And that has been applied as a blanket rule in relation to resolution of tax disputes. Now, the question you've asked is what my thoughts are with regard to whether tax disputes should be settled by arbitration. Now, that decision, first of all, in relation to domestic tax disputes is fine in the sense that it aligns with the provisions of our Constitution, and also it aligns with the provision of the Arbitration and Conciliation Act, specifically Section 35 of the Arbitration and Conciliation Act of Nigeria states that any matter that the court has the right to set aside any arbitral award that relates to a matter that is not subject to arbitration under any law in Nigeria. And so because Section 251 of the Constitution gives the Federal High Court exclusive jurisdiction over the resolution of tax disputes that relate to federal taxes, it then means that for domestic tax disputes. The Federal High Court has that exclusive jurisdiction, of course, after a taxpayer has sought remedy from the Tax Appeals Tribunal. Now, but in relation to cross-border transactions, especially where the contention relates to the sharing of taxing powers between two different jurisdictions, it then becomes a challenge when the taxpayer is unable to take that matter outside of the Nigerian jurisdiction. So there are two scenarios that can play up in that case, where that taxpayer is from a country that has a double tax treaty with Nigeria. We have the mutual agreement procedure, which is a dispute resolution mechanism that the double tax agreements provide. But the mutual agreement procedure, which we'll call MAP, is limiting in the sense that it gives the tax authorities in the jurisdictions involved an obligation to settle the matter. So they're not bound to settle the matter. In fact, when you look at the wording of the of Article 24, for instance, in the UK Nigeria Double Tax Treaty, it says that the competent authorities, in other words, the tax authorities in both jurisdictions, will endeavor to resolve the matter. Also, the types of matters that you can bring to a MAP involves the interpretation of the provisions of a double tax treaty. So what then happens to a taxpayer whose country does not have a double tax treaty with Nigeria, and where the contention here is that the other jurisdiction has a right over that particular income, not Nigeria? What does that taxpayer do? That taxpayer has recourse to Nigerian court. Also, sorry, Barrister Isa, could you mute your microphone? I think.
Okay.
Thank you. So also, the mutual agreement procedure has other limitations. One is, as I said, is that the tax authorities are not bound to resolve the dispute. The second also is that where the MAP fails, the taxpayer has no further recourse, because in Nigeria, even if that taxpayer decides to go to arbitration and he seeks to implement or enforce the arbitral award in Nigeria, he will not be able to do so. So these are the challenges that we are faced with. And, you know, ultimately, so you asked what the implication of this is. The implication is that this has a potential of impeding foreign direct investment, in the sense that a taxpayer, if a foreign taxpayer that finds itself in this sort of situation will feel frustrated and may feel denied of its right to a fair hearing, where only the domestic court can rule on that matter. So, and also when you look at the ongoing global reforms, so Nigeria, of course, as you know, is a member of the OECD Inclusive Framework, and by virtue of that, we have subjected ourselves to the minimum standards, one of which is Action 14, which of course provides that members of the Inclusive Framework, you know, should include arbitration as one of the dispute resolution methods. But again, countries have been given the right to make reservations regarding those provisions, and Nigeria has made a reservation concerning that and has said it will not opt for arbitration. But how sustainable this is, we'll soon see, because ultimately a lot of the treaty partners that we have, apart from the MAP, having the MAP provision in the treaties, have opted for arbitration as, you know, recourse where a MAP proceeding fails. And if we do not allow that, how then we now have a mismatch, and that now creates a measure of uncertainty for taxpayers. And if there's one thing that taxpayers are weary of, is that lack of certainty and the lack of the ability to seek recourse on their rights. So I think that in future we need to revisit the issue of arbitration, especially in relation to cross-border transactions.
Thank you so much, Elo. Very insightful points you made. And I mean, like you said, the fact that in our jurisdiction in Nigeria, tax matters are not allowed to be settled through arbitration could actually impede foreign investment. And I'd like Mrs. Layclock to share her thoughts from an international perspective. Sarah, could you share your thoughts on how tax matters are settled through arbitration internationally and the approaches that you've seen in other jurisdictions?
Yes, thanks, Kaleki, and thanks, Mrs. Asami, for what you've just presented this afternoon, because I think it's a really interesting point. You've talked about two different types of arbitration, and I think it's really important to understand the differences between, because we talk regularly about arbitration in a tax context, but many people are at cross purposes about what we're talking about when we're speaking about arbitration, because there are multiple different types of arbitration. So when you're talking about the case that was decided concerning the production sharing contract, the nature of that arbitration is more akin to what is known more generally as commercial arbitration. And these are often negotiated clauses, and in the tax context, they're called tax stability agreement arbitration clauses. And the concern that many people have around those is that a country will look to attract foreign direct investment to that country for the purposes of ensuring that they get long-term infrastructure projects. And so they're looking to get private investment flowing into the country so that some very important infrastructure is built in order to provide some value back to the country itself. And in doing so, the country's administration, the government, will make an agreement as to what the tax circumstances will be with respect to that particular infrastructure or other contract. And one of the aspects that the generally a multinational or other type of corporate will seek in terms of making that investment decision is that there is a clause which allows them with timely certainty over any dispute that might arise concerning tax. And so in circumstances where arbitration is not available, there becomes a question about whether the local court system is able, in terms of its capacity, to manage a dispute within a timely manner to provide certainty to the foreign investor concerning the actual underlying contract between the government and that investor. And so that becomes a real question about the stakeholders here. Just turning to then the other type of arbitration which was raised, which is a question around arbitration under the mutual agreement procedure, the MAP article of tax treaties. And of course, this is something which Nigeria has reserved upon, and many other countries have too. So we need to appreciate that this is not something that is clear-cut internationally. There are around 30 countries internationally who have agreed to the MAP article having an additional clause which allows for mandatory binding arbitration. And this is in the context where there are two countries making a determination under MAP about the resolution of double tax and which country has the right to tax and to what level. And so it's not that one country doesn't tax and the other country gets everything. It's that there is a a determination as to who has the taxing right and to which percentage, having regard to the circumstances which is put before them. Now, we haven't had to date any tax arbitration, any mandatory binding tax arbitrations that have been commenced under what's called the multilateral instrument, which came out of BEPS 1, out of Action 14. And so it's difficult to know what this is going to look like. However, we have had a number of matters which have almost gone to arbitration. And what we are seeing is the almost. So what we're seeing is that the mandatory binding arbitration clause places the competent authorities who are administering the mutual agreement procedure for the countries concerned in a position where the endeavours requirement places them into a position where if you don't make that decision, then the decision will go to a panel of arbitrators, one, of course, which is appointed by the country concerned. The other is appointed by the other country. And then a chair, most often, is appointed by the two arbitrators that are appointed by each of those countries. And that chair comes from a short panel list, which is essentially agreed to by those two countries. So there is control over the decision makers. So the big question is whether that helps to resolve these double tax disputes. And that's a question for each country to consider.
Thank you so much, Mrs. Blakelock. I mean, very useful points that you've made. Thank you for sharing your perspective from an international standpoint. I can see some people are raising their hands from the audience. Please note that we would only take questions that have been directed at the Q&A box. So please send your questions to the Q&A box, please, and we'll take those. We won't be able to take direct live questions. Thank you. Mr. Ayodele, bear with us. We'll be coming to you. The next conversation is really an interesting one, and it would be good to hear what the FIRS, you as a tax authority official would say in response. But the next question is directed at Mrs. Sosami. And, the question borders around cooperation between taxpayers and the tax authorities. Would you say that compliant companies are less likely to have additional tax liabilities? Or, does it really matter that companies are compliant? And why this question is important, Mrs. Sosami, is because we found that, Barrister Eze, the chairman of the Tax Appeals Tribunal in the Southeast, had mentioned that oftentimes you find that companies are compliant, but doesn't stop, the tax authorities from still asking for more money, slamming additional liabilities. So we'd like to hear your thoughts on, cooperation between tax authorities and taxpayers in terms of compliance.
Okay, thanks, Kelechi. I think in terms of cooperation, I think that still leaves much to be desired because the trend we have seen is that even where a company has been compliant, it's as if the FIRS always has a presumption that that company is still hiding something or, has not paid sufficient taxes. And so there's always a measure of tension, that comes with audits and post-audit reconciliation meetings and what have you. And there appears to be a general presumption that at any point in time, a taxpayer is hiding something. So that's quite unfortunate, because where a company has done everything correctly, has the proper documentation in place, has no skeleton in its cupboard, has provided sufficient information to show that it has been compliant and then still being treated with such suspicion, I don't think that engenders good relationship between taxpayers and the tax authorities. So we still see quite a bit of that. On the other hand, we also sometimes come across situations where the tax authorities are willing to accept the position of the taxpayer. But this usually is after much back and forth, you know, so I think there's still room for improvement in that regard. But I think that taxpayers will not go wrong if they continue to make sure that at any point in time, every position, every statement that they have made, you know, every representation that they have made in their returns can be justified by documentation and sufficient information.
Thank you so much, Mrs. Susumi. Thank you for that point. And I know prior to this session, while we're preparing, there were some recommendations that had come up, and about how taxpayers and tax authorities could cooperate more to make the environment more suitable for businesses to thrive. And I'd like to direct this question to Mrs. Blakelock. One of the tools that we've seen, in terms of cooperation between tax authorities and taxpayers has been advanced tax rulings and advanced pricing agreements, where, like Mr. Ayodele had mentioned earlier on the call, where taxpayers could, seek clarification from the tax authorities regarding transactions that they are not so clear about, and also, filing advanced pricing agreements with tax authorities from a transfer pricing perspective. And we've seen that these tools have been used in other jurisdictions very effectively in, building that cooperation and that, cooperation basically between taxpayers and tax authorities. But I'd like to ask Mrs. Blakelock, from your view and from your experience, how effective have ATRs and APAs been in the jurisdictions that you've worked with as a tool to manage compliance and avoid disputes with tax authorities?
Yeah, this is a really good question. So let me just start with cooperative compliance and just covering off on that. And just to note that every country around the world has a different approach to cooperative compliance. It was something that really started from the OECD about 15 or more years ago, and has been taken up in a different way in many different countries, and is also reflected quite often in terms of the design, the system design that the regulator has adopted, or the legislation that underpins tax administration in each different country, about what a fiscal authority can and cannot do in terms of cooperative compliance. And there often is like a bit of a spectrum. I'm just trying to work out how to get my hands in the screen. A spectrum between those countries who have advice and guidance and engagement ability and powers under their tax administration legislation. And then at the other end of the spectrum, those countries, which is a bit more like the UK, which has less scope for guidance and engagement with taxpayers, and so has a cooperative compliance program, which is then reflective of that. And so at one end, at this end, where there is high levels of advice and guidance and engagement, is probably the country of Australia, where they have both public and private ruling programs, and many of them are binding on the fiscal authority there. And they also have high levels of developed advice products, and also high levels of taxpayer engagement products that they have in order to fulfill cooperative compliance. And that said, they also have a very advanced form, a very mature, when I mean advanced, I'm saying mature form of cooperative compliance, where they call it justified trust. And they say that this is very important in terms of building trust between taxpayers and the revenue authority in that country. But there's also a question here about what does it mean to have trust between a taxpayer and a revenue authority? And I just thought it was worth mentioning the work of a global philosopher, Professor Honora O'Neill, who talks about trust. But she says the question is not about trust. It's actually about trustworthiness. And it's about trustworthiness in all the very many different facets in which that arises. And some of that trustworthiness is about the system in which we develop in terms of making decisions, so your regulatory system. And on the other hand, it's also about the question about how taxpayers engage in that system. And there's really three things which he says are really important in terms of establishing trustworthiness in both systems, in experts, in regulators, in the way that taxpayers engage from an evidence and in compliance perspective. And I just wanted to just touch on those because some of them we've actually spoken about today. One of them is about this question about commitment and competence, and that's about that your actions live up to what you commit to and what your competence level is. And this plays out, I guess, in cooperative compliance programs, because if a regulator has said to a taxpayer, we have these expectations and we see that you're falling short of them, when we come to talk to you again on risk, we'd like to talk to you about whether you have strengthened your competence and your credibility on risk. And that's a question of trustworthiness. The other indicia is reliability. And that's about whether the actions of both the regulator or the taxpayer here, just trying to get my hands in there, that they're two meeting what you'd say are your norms of reliability, both in word and in deed. And then the final thing she talks about in terms of trustworthiness is honesty, not in the subjective sense, but in an objective sense. And that's around this question, which is often talked about data governance and data management. But there's also this question about data provenance, which I think is going to become even more important going forward. So let's come back and talk about rulings here. Where there are tax authorities in many different jurisdictions where it takes a very long time to negotiate a ruling, then there is a question, I think, in the mind of multinationals and corporates about the value of investing in that process and whether the value outweighs the time it takes to actually enter into that negotiation. So if you're looking for advanced tax rulings, multinational or a corporate taxpayer is looking for the advance aspect of the tax ruling, not it being one that is laborious for them to actually obtain. And then, of course, advanced pricing agreements also have this issue with advance in it. But there's also the question around rulings about whether they're binding. And in some countries, rulings are not binding, and advice is binding or not binding. And so there's a real question about how do you balance that and where does that sit on that spectrum? I hope that is sort of helpful.
It is, Sarah, thank you very much. And like you said, I mean, just to share some perspectives for Nigeria, advanced tax rulings are not binding. And we've had court decisions where the courts have held that the tax authorities cannot advise out of what the law is. So you find that most times taxpayers apply to the tax authorities for clarification. The tax authorities provide their view of what the law is. The taxpayer applies to the tax authorities' position or advice, and then later in the future, the tax authorities come back and say, oh, you know what, our position wasn't correct, or, you know, so, and sometimes they seek to renege from the clarification they have provided, which puts the taxpayer in a bad position. So which again makes the point about trust very important, that there has to be that trust between tax authorities and the taxpayers. And thank you so much for that point. And at this point, I'd like to refer to Mr. Ayodele. I mean, you're an official of the tax authority. You are familiar with some of the issues you've spoken about. I mean, do you have any response around the recommendations that Mrs. Blakelock has shared on the call? You know, you could also highlight to us what the FRS has been doing to, you know, foster this cooperation between itself and the taxpayers, just to build a trust.
Okay, thank you for having me, Mr. Kleke. I think I quite agree with the last speakers about trust, because when there's no trust, so what happens is misunderstanding. And this misunderstanding will create tax exposures and also even elongate the reconciliation issues, the tax audit issues and all that. I think from a tax authority perspective, what the authority has been doing over the years is to, enhance the dissemination of information to the taxpayers, because when there's no information, it means that people can actually do wrong things. Taxpayer by issuing, circular from time to time to clarify the amendment, as the case may be. You recall when when Finance Act 2019 and 2029 came on board, there was a follow-up circular to further explain the provision of these Finance Acts, to explain in details what each amendment to various tax types is trying to resolve. And it beholds on the taxpayer to key into this time-to-time information dissemination for them to be abreast of what is happening in this regard. And another thing is that, like I said earlier on, that there is also need for taxpayers themselves to seek for information, because the truth of the matter is that there's no way you can know the house more than the owner of the house. If you don't ask questions, if you don't seek for clarification, there's no way you can better position yourself when it comes to tax issues. So there is need for mutual trust, mutual information sharing between the taxpayers and the tax authorities and all that. I know this will resolve all these tax issues and all that. Thank you.
Thank you, Mr. Yodili. Thank you very much. And to our participants, thank you for staying through. Just to assure you that we'll be wrapping up the session in the next 10 to 15 minutes. You've been really patient, and I'm sure you're enjoying the conversation like I have. And the final question, at least for the panelists, now I would address to Mrs. Sosami. You're a tax practitioner, and I know you've advised multinationals and top companies on managing their tax obligations and some of the tax issues that they encounter on a day-to-day basis. Are there other things you would like to share that stakeholders should take note of in relation to tax compliance and dispute resolution, from your perspective as an advisor?
Thanks, Kelechi. We've spoken a lot about compliance. We've spoken about the importance of record keeping, documentation, and testing tax positions and structures against certain standards. I think that in the few minutes that I have, what I would like to emphasize, particularly to taxpayers, is also their role in developing the tax system. And that role comes from the angle of controversy. We find that there's still great reluctance on the part of taxpayers in Nigeria to test the provisions of the tax laws, to test the actions of the tax authorities. A few taxpayers who have been brave enough to do this have actually helped in providing clarity on certain gray areas that exist in the interpretation of our tax laws. And so as a major stakeholder when it comes to taxation, I think taxpayers in Nigeria, having put their house in order properly, do what is right, be compliant, then go a step further and test some of these provisions rather than shy away from that and allow wrong precedents to be created, because a position would remain unless somebody comes forward to challenge it. So that's a major takeaway that I would leave for taxpayers. For the tax authorities, and Mr. Adele, we're so happy to have you here with us today. And we've talked about the issue of trust. I think that the tax authorities definitely need to lower that barrier of mistrust and suspicion. Yes, the purpose of a tax audit is to see whether or not a taxpayer has complied. I think that there are sufficient rules that govern an audit process, and we should allow these rules to take their course rather than introduce, subjective angles that are coming from a place of great mistrust and suspicion. And I think with all of this, we can only improve our tax system. And of course, as advisors, we must also keep abreast of the law, and we must also make sure that we encourage our clients to adopt compliance as a means of tax planning, as opposed to aggressive avoidance.
Thank you so much, Mrs. Ososami. Great point you've made. There's really no way we can improve our jurisprudence if taxpayers shy away from questioning some decisions or actions of the tax authorities. So that's a great point you've made, and we'd encourage taxpayers to rise to the occasion every now and then. And thank you. We've taken the questions for the panelists, but we do have a couple of questions in the Q&A box, which I'd like to address to some of the panelists. The first of which is addressed to Mr. Ayodele. One of the attendees is asking that given the advent of information technology and global best practices in tax compliance enforcement, should the issue or the challenge of tax under remittance by government agencies and corporations be a thing in this age? Can the FRA, essentially, I guess the attendee is asking, shouldn't the FRAs be relying more on technology to detect under remittance, rather than having to go through rigorous processes and audits to identify that the taxpayer hasn't paid some taxes? So the attendee would like to hear your thoughts on that matter.
Well, okay, thank you for that question. It's a beautiful question, and I think my response to that will be, I'm aware that a couple of sectors have been integrated with IT, such that tax authorities, FRS, for instance, can manage or can determine what goes in terms of value-added tax. I know for shipping, for airline, that one has been deployed. I'm also aware that there is ongoing process as far as telecommunications as well. But beyond this, I think it's still important that the taxpayer also fulfill this tax obligation, because the truth of the matter is that, for instance, for VAT and withholding tax, they were borne by the taxpayer themselves. What they just serve is an agent. So, but it is important for taxpayers for companies to automate their systems such that when such transactions occur, the relevant or the associated transaction taxes like withholding tax and WAT can be captured, because we have companies that adopted this system and is working fine for them. So my advice will be that companies should also adopt this technology by automating their system, such that when an invoice from suppliers hits their system, the relevant transaction taxes can be captured, and at the end of the month, when there is, the time for the filing and the remittance is to be done, they can do it without leaving anyone out. Because if you do this by manual process, of course, manual process is prone to errors. So there is possibility that a lot of the transactions will not be captured. And when the auditor comes, it becomes an issue, because they want to ensure that all the withholding tax or value-added tax that are due on those transactions have been deducted and are remitted accordingly.
Thank you, Mr. Ayodele. Very important point you've made, and I think that still goes to the issue of cooperation that we've been speaking about on the call. The adoption of technology both by the taxpayer and the tax authorities, and how these technologies could communicate with themselves to make the issue of compliance very seamless for the tax payers. And I'd like to balance the questions. There's a question for you, Mrs. Blakelock. And an attendee would like to know, how important is compliance with local laws for multinational entities that operate across various jurisdictions, especially when you consider the cost of compliance? And are there ways that these MNEs can manage this cost, from your experience, from your international experience?
Thanks, Kaleki. This is a really interesting and important aspect of what multinationals seek to do in terms of managing their tax affairs across different jurisdictions. Of course, it's a challenging aspect for multinationals because they might be operating in numerous jurisdictions, and each jurisdiction has its own particular set of rules. But in my experience, multinationals do take compliance as a very high order and as of great importance to them. One of the difficulties I think that multinationals have is that there will be nuances in each different jurisdiction, and getting a better understanding of what the law and how it will be interpreted in those jurisdictions will mean is one of the difficulties. One of the other difficulties that multinationals experience is where there will be positions taken by tax authorities in those jurisdictions, and then that position then changes at a later date. And they've been proceeding along the basis that the understanding of the law and the way that they have been applying that law to their tax positions is one thing, but then a couple of years later, that reverses to being something else. And that is a challenging position. And that's something which the multinational would argue is not a problem of them being compliant. It's that there is a change in approach. And that's a question of improving engagement, I think, between taxpayers and regulators as views change over time.
Thank you so much, Sarah, for that response. There's one more question, and I think it's a really important question for Mrs. Lolode Asosami. An attendee would like to know whether, there's actually the taxation of the digital economy has resulted in an increasing number of disputes between MNEs and tax authorities, especially in Nigeria. An attendee would like to know how this will impact businesses, and do you see the trend of these disputes continuing?
Thanks, Kelechi. Absolutely. That's not surprising, and it's not only in Nigeria. The truth of the matter is that the evolution with regard to the digital economy is the underlying trigger of the ongoing global tax reform, which has led to a rewriting of the rules. And so those rules are being rewritten. When you hear expressions like Pillar 1, Pillar 2, and all of those are rules that are being rewritten. In the interim, however, certain countries have taken to unilateral measures, such as the significant economic presence rule that we apply in Nigeria, for instance. And so as long as these unilateral measures are ongoing, as long as the rules are still being rewritten, there's a lot of uncertainty. And so this, of course, give rise to disputes. So I see the trend continuing. Even after the rules have been rewritten, the trend would still continue because it's a very, very complex field. It's a very complex area, and even more complex for Nigeria in particular, because right now, Nigeria has refused to sign up to the two-pillar proposals that the OECD is still developing. That's not to say that the two pillars are definitely going to be implemented. We don't know yet, but Nigeria has taken a position, but there are still moving parts, to the implementation of that proposal. So for as long as these uncertainties exist, we can expect to see a lot of disputes arising.
Thank you so much, Mrs. Sosomi. I think unfortunately, that's much of the questions that you can take today. We've exceeded our time by 10 minutes. And I mean, can't blame the speakers. It's been a super interesting conversation. I totally enjoyed myself, learned so much, have a lot of questions myself, but unfortunately, we can't take everything today. So I'd like to thank all the speakers. Thank you so much for honoring our invitation and for being patient and for delivering value. I'm sure the participants have learned so much. And thank you also to the attendees who have stayed through the sessions and have been patient with us. We're grateful. Would like to say that EBO is happy to support you. We have a strong tax team and a strong tax controversy team as well. So should you need support in terms of tax risk management, tax disputes, controversy, you could just send us a message. We're happy to support you. And if we haven't responded to your questions, please you could send them by email to events@bbpo.org. We would send a response to you by email as well, since we can't take all of the questions live today. So thank you so much, everyone. Appreciate your time. Elo, do you want to say something before we close, or do we just
to add very quickly that the
Okay.
I-Series continues tomorrow. Tomorrow is the panel on ethics, and that also promises to be exciting. So please join us tomorrow. Thank you also very much.